We had some drastic changes in our market this week, as well as some key data that's come out recently proving several of my theories correct. I'll be going over those stats and stories in today's update, and stick around to the end where I'll share with you home buyers a free program you'll want to take advantage of in the coming months to help you find the home you want at an incredible price. That's all coming up right now. If this is your first time to this channel and you want to know everything about living, buying, and selling in Southwest Florida, then subscribe and tap the bell for notifications so you can be the first to know about the current market, latest news, and newest tips to keep you ahead of the curve. I'm Rick Harrison with the Home Sold Guarantee Group at MVP Realty here in Southwest Florida, and my team and I are getting calls, emails, and texts every day from people just like you looking for help on making their move to the greater Fort Myers area, and we absolutely love it. Whether you're moving in 9 days or 90 days, give us a call, shoot us a text, send an email, or even schedule a Zoom so we can help you figure out exactly what you want and where you want to be. All of our information is in the description below. So as I mentioned, we're talking about some data that's come out proving my skepticism right over the last several months with the data that we've been getting from government sources and some dramatic changes in not only the broader housing market, but more especially our local market. So let's get right into this week's local market stats. So starting off with the southern part of Southwest Florida, as I always do, from Cape Coral up to Naples, from Cape Coral down to Naples. New listings last week were at 688, which was a slight decrease. But this week we're actually seeing a pretty large decrease. New listings went down to 409. That's down 41% from last week. Solds went from 608 to 437. That's down 29%. And then pendings went from 670 to 461. Just as a recap, I know many of you already know this, but solds is an indicator of what happened a month ago, or maybe even a little bit further than a month ago. But pendings is what's going on in the market right now. So to see pendings drop 32% week over week is indicating that a lot of buyers are now starting to sit on the fence again, and they're starting to exit the market again. We're also seeing the price decreases down from 542 to 292. Again, that's kind of an indication of the fact that new listings are down so drastically, as well as pendings and sold. So people are understanding that the market has shifted a bit. Homes are sitting on the market longer, so we're going to see probably price decreases slow down a bit, where we've been seeing them at all-time highs for the last several months. Inventory breakdown, despite us actually looking like new listings have declined quite a bit, we're actually seeing that inventory is still gaining. Single families are just down 9, so they pretty much stayed the same. But we did see condos actually gain a bit, 56 from last week. So we had a net gain last week of 176. This week we only have a net gain of 47, but still it's a gain overall, which means more people are putting their homes on the market than buyers are willing to buy. Multifamilies up 12 this week, decent rate, but still we're still in the pocket that we've been seeing multifamilies around the 140 to 150 range. And then foreclosures did not change at all for the southern part of Southwest Florida. Moving into the northern part, PUNTA, GORDA up to Sarasota. New listings went from 1290 last week to 786. Again, pretty much the same thing, down 41% in this market as well. Solds went from 1355 to 1148, down 16%. Not quite as drastic as the southern part of Southwest Florida, but still down. And then pendings 1443 to 917. That's down 37%. So pretty much in line with the southern part as well. Again, here price decreases was down almost 50% from 1923 to 940. So we're seeing a lot less decreases in this market as well. Looking at the latest inventory breakdown for the northern part, we did have a gain of 41 in the single family market, and we also had a gain of 12 in the condos. So pretty much in line. We have a net gain of 53 where we had a net loss of 32 last week. And then right along with that, in the same kind of trends that we're seeing in both North and Southwest Florida, multifamilies really didn't have too much of a change, right around the 50 to 60 mark. And then foreclosures, a loss of 4. So really that's where they've all been hovering around throughout really all of Southwest Florida. Interest rates went from 6.09% to 6.31% according to NerdWallet. Bank rate had it going from 6.6 to 6.57, so actually down a little bit, but both of them have them right in around the 6.25 to 6.5 mark. Keep in mind, these are just averages. There are people right now still getting mortgage rates in the 5% range. And I've mentioned several times in past videos, a lot of the builders right now are doing interest rate buy downs or mortgage buy downs, where they're actually buying down your rate either for a couple years where it would be an adjustable rate and it would move up slightly, or some of them are actually buying down the rates for the entire term of the loan for all 30 years. So if you have any questions on that, feel free to reach out to me. I do know of plenty of communities and builders right now that are offering incentives like that. So you still can get some pretty good deals right now for buying homes through new communities. And that's going to be important in one of these next stories that we go into, where I'll explain why it might be a good idea to consider buying in the next couple months before things really start to change. What's the scoop? All right, so first I want to take a look at the bond market because it really did stop on my target. If you looked at my thumbnail image, you can see I predicted where it was going to hit and top out and where it was going to start to sink again. So, but there's some things that we need to take a look at with the bonds. So, as I've been going over the last 3 or 4 market updates, I showed you kind of what the bond market was indicating. The reason the bond market is important is because this is indicating where mortgage rates are headed. We're right now looking at the 10-year bond, the U.S. 10-year bond, and just based on technicals, which is what I usually look at charts by, we can use certain indicators and trend lines to really determine where things are going. But we had a double top here. Either way, it's a descending wedge, which about 80% of the way through, you take the measurement from here, from peak to trough, and then you move that line down about 80% of the way through, and that's usually where the market is going to break out, which it did. It broke out a little bit earlier than what I was expecting, but it did kind of retouch and go back down to where I expected it to go. And then if you take a look, I said that trend line up here at the top, this white line horizontal, was where the bonds were going to top out and they were going to stall. And then they would probably head back down lower. Now, it did do exactly what I was predicting it was going to do. Not really a prediction. It's more based. It's really probabilities based on the technicals here. But one of the things I do want to show you is that although it did peak out and stall and actually went back down a little bit, if we take a look at the MACD down here, which is showing that it has started to slow down and actually go the other way, until those two lines cross, the blue goes over and back underneath the orange, it really isn't a confirmation that it's going to be heading lower. So this could actually go back up, and that's indicated by the RSI at the bottom here. As you can see, usually when it hits a top, it gets up to this line at the top, this dotted line. When it hits up here, that's usually where people sell. Right now, we're only midway through, so there's quite a bit of room to the upside. This could actually pick back up and go higher. If that does happen, that means that mortgage interest rates are probably going to go higher too. But as of right now, it has stalled, at least temporarily. And we'll have to see if this becomes either a support line or a resistance line. If it becomes resistance, it'll head lower. If it becomes a support line, it'll actually continue higher, which I know a lot of people have also said. So right now, there's definitely a lot of room to the upside. So I said in the short term, we probably were going to see some pain with the mortgage interest rates. And, as of right now, there's definitely some room for pain to continue going higher. So for those of you who are waiting on the sidelines for mortgage rates to come back down, it could be a while, but at least for right now, they are slowing down and heading lower. All right, moving on to the next story. So this comes from Redfin. These are actually 2 stories coming from Redfin, but the housing market, the monthly payments for housing have actually decreased $300 less from the October peak, which is starting to bring back some home buyers. And I spoke about this in the last 2 market updates. We are seeing the interest rates head down. They're in the 6% versus the 7% highs, which has brought more buyers back into the market. So homes were selling at 352 ending in December, which was at a peak 391, up 10% in June, just about a year ago. So, less than a year ago. Average mortgage rates declined for the 6th straight week to 6.27%, which is cutting nearly $300 per month off of mortgages from the highs. The average home was listed for 39 days before going under contract, so they are sitting on the market quite a bit longer, which is the longest period since August of 2020. So that's really back in the beginning of the pandemic and the start of that. But it's also contributing to the biggest supply increase on record. So I know there have been some other YouTubers in the area that have been saying that there's really not a lot of inventory, but inventory is building up. It really is. Even looking at the local charts, we're going to take a look at one later, and we'll see that the market has been shifting quite a bit. Quite a few buyers have come out of the woodwork in the last few weeks as rates have fallen. Many people who were outbid on multiple homes during the buying boom want to seize this moment because they can take their time touring homes and negotiate on price and terms with sellers. So some of you out there that I have spoken to, I did warn about the fact that when mortgage rates start to slow down a little bit or even decrease, the buyers that have been waiting patiently are going to be entering the market, which is going to put a little bit more stress on what is out there for inventory. And usually the best houses go first. So that's something to keep in mind if you are sitting on the sidelines, not to cause a panic and not to rush you, but that is something to think about that buyers may start entering depending on what happens with mortgages. Uptick in early stage demand hasn't translated to more pending homes, sales, or new listings yet, mainly because a lot of people still are waiting and hoping for a crash. But we're not really sure if that's going to happen. Sales aren't likely to tick up until mid-January, partly because the holiday season is typically slow, and new listings may not start recovering until spring, according to Redfin economists. Not that we should be listening to Redfin economists. They also had to close down their iBuyer program because it was losing them money as well. So another story, luxury home sales sink 38% to the biggest decline on record. But that actually outpaced the regular non-luxury homes, which also decreased 31%. Luxury properties are frequently used as investment properties, and with home values and rents poised to fall in 2023, investment prospects are lackluster. Some of you I've spoke to, I have been mentioning that a lot of investors are starting to hold off. They're still looking for good deals, and there still are some deals to be found, but there's a lot of people holding off, saying it's not the best time to buy for investment purposes. Affluent buyers often have significant funds stored in the stock market, which has been losing value. This is something I talked about over a year and a half ago, that this was the big thing that I was going to be looking for in the market, was that, yeah, okay, this is not 2008, or it might not be 2008, though it's starting to look like it could be. While it might not be 2008 because of the mortgage-backed securities and the way mortgages are underwritten, the big thing is that it's all about supply and demand. If a lot of affluent people or people who have multiple properties start losing money in their portfolios, that wealth effect, that really makes them feel like they're not as rich or as wealthy as they once were. What do? You're going to sell the things you don't really need right away to put that money back into the portfolio, because you want something as a nest egg later on. Whereas the property, you can always, reinvest in property later on when times are better. So that was the big issue, and it looks like that stuff is starting to play out, although, I was way ahead of the curve on when I called that. Also, one of the things I mentioned a couple months ago was based on the data that we were getting from the Federal Reserve and the BLS, was the amount of job growth that we've seen since the pandemic crash, and where a lot of people lost their jobs. They were reporting 300, 400, $500,000 job growths per month for several months in a row. And I was like, where are these jobs coming from? Well, I said, the data seems like it's probably skewed a bit, and people aren't taking into account certain things where, people might be working multiple jobs. Well, now it's come out, and CNBC reported on this. I'm not going to go through the video, but obviously you can tell by the headline, BLS overstated job growth in second quarter by 1 million jobs. So we really did not get all of those jobs that they were reporting. And it's likely that, I think the report that I had read was that we've only actually gained 10,500 jobs since the recovery period. So versus the million or more that they were reporting, we've only gained 10,000. So that tells you that, the economy is not in as good a spot as people have been expecting due to the data that we were getting. Moving on to the last thing was the balanced market. We have returned to a balanced market. 21 weeks. That's the weeks of supply inventory. For those of you who are familiar, a balanced market is considered about 6 months of supply. 21.2 weeks is about 5.5 to, it's right about 5.5 to 5.75 months of supply, which means we're actually entering into a balanced market. And we've been kind of teetering on that for the last three months or so. So I think we're going to see quite a bit more inventory depending on what happens with mortgage rates. But, yeah, we are entering into a balanced market. So what does this all mean for you sellers out there? I think, I think you're seeing the results of the market shift right now. We're not really seeing the peak highs that we were getting. Homes are sitting longer. So if you are planning to sell, you got to have a little bit more realistic expectations with selling. Just expect, your home's probably going to be sitting for 30 days or so, and you need to price properly. So don't price too high. I know, it's always tempting to try to price a little bit higher so that you can, have some wiggle room if somebody offers you a lower number. But honestly, the best way to do it is to price it at market value. That way, you're not going to get you're not going to get low balls, which are going to make you feel even worse. Two, it's not going to sit on the market longer, which when a home sits even longer than an average, people start to wonder what's wrong with it, and then they just stay away from it altogether. So that will just disappoint you completely. But for you buyers out there, the other thing, the other side of this coin is that if mortgage rates do go down, more buyers are going to be entering the market. So if I'm not saying you should go out and buy. You need to do what's best for you. If you can buy, it might not be a bad time to buy. You're not going to be dealing with a lot of competition right now. But again, if you do want to wait, just keep in mind, I do have that program that will be helpful if it is, a competitive market again. That will be something that you can take advantage of with that program. But, just keep in mind, if things, depending on which way they shift, things could get more competitive, or they could really slow down a lot. And if mortgage rates keep going up, I think you're going to see a lot less buyers interested in buying and probably sitting on the sidelines even longer. So it really just depends on your timing. If you can wait it out, you might be able to, but just know that it's not guaranteed that the market is going to get any better. But we'll have to see where things go. Now, for you home buyers who have been patiently waiting, I want to make sure you know about this free program I offer that will help you find perfect homes at incredible prices, no matter if it's a buyer's market or a seller's market. I know over the last couple of years, buyers have been fighting against all cash buyers, had to enter bidding wars that bid homes out of reach, had to waive inspections and appraisals, and their financing wasn't even considered. And worst of all, many were just settling for whatever they could get. My clients went through the same issues at first, but I've been offering a program to my clients now for about a year that I've fine-tuned that allows me to market my clients' search criteria to homeowners who are likely to sell at a 90% rate within the next 3 to 6 months. It's completely eliminated bidding wars and buyer competition. It's allowed me to guarantee a sale price $10,000 below market value, and I'm proud to say I've included some awesome incentives for clients. This is mainly for people looking to buy in the next 3 to 6 months, but if you'd like to reserve a spot, since they are limited, because it takes me quite a bit of work and effort for each client, you can reach out to me and just let me know when you plan to buy, and I'll save a spot for that cohort. And if you want to learn more, I put a link in the description below, my contact info to a video that explains all about it. Well, that's it for me today. If you got value out of today's video, please hit that like button and to let me know. And don't forget to subscribe so you're the first to be notified of the latest data, tips, and happenings in our market. And again, please don't hesitate to reach out for help or questions. I hope to see you again next week, but until then, stay safe, stay positive, and more importantly, stay free.